Thanks, Barbara, for the introduction. And it's good to see you, Klaas, on a truly, of days of truly tragic events and in many parts of Spain. And as somebody who lives in Spain himself, I even feel more with Spain than others. What you didn't mention, Barbara, is that Klaas has been on the Governing Council of the ECB now since the mid of 2011, so he's the longest standing member of the Governing Council, and he has, of course, been governor of the Dutch Central Bank for the same time. But more recently, in the end of 2021, he became the chair of the Financial Stability Board. And that gives us the chance to talk about financial stability a little bit more on a global level than purely on a European level. And let me start with I have many questions, but let me start, please, Klaas, with a very open question. And if you look back to the last 15 years and the financial crisis we have had there in this period of time, so what are your reflections on progress made or progress not made?
Thank you very much, Andreas. And I also want to start by expressing my sincere condolences to what happened elsewhere in the country over the last few days. I couldn't help thinking that if ever somebody still challenges the issue of climate change and the disastrous effects that it can happen, really unbelievable. And I think it would be a big failure of international coordination and international cooperation if we had to take a step back in the fight against climate change, which really requires a global response because there is only one global climate. Okay, but coming back to your question and closer to home, as I would say I need to be the two-handed economist here. There is good news and there is less good news looking back 15 years ago. Obviously, it sparked the global financial crisis, 2008, 2009. It sparked a major financial reform agenda, which was heavily focused on the banks. So we had two sort of Basel III packages, 2010, 2017. And when we sort of came into a new situation with renewed turbulence, actually the banks as core of the financial system, they held up pretty well. Let's take this thought experiment. If you had asked me 2.5, 3 years ago, you would have told me that all major central banks in the world were about to raise interest rates by 400, 500 basis points within a period of 12 months, which we know constitutes a massive shock to the financial system. And that the only victims then would have been a couple of second-tier US banks that were kept out of the international regulatory perimeter anyway, and one institution that was already limping along for a while, and whose failure, I believe, had nothing to do with the things that the international regulatory reform agenda looked on. I would say, so far, so good. It could have been a lot worse. Unfortunately, on the other hand, there's not only banks, there is also market-based finance, which we call NBFI, non-bank financial intermediation, one of these wonderful acronyms in our world. And there, I think the events of the last, let's say, 5 years or so have exposed some significant vulnerabilities. We had the Dash for Cash in March 2020. We had the Archegos case. We had the commodity traders in February 22. We had the UK LDI pension issue. And all of these episodes had in common that there was a combination of a significant liquidity mismatch, a significant spike in liquidity demand that could not be solved by the institutions themselves, in combination with pockets of hidden leverage that we had not expected to be there, but that came to the surface unexpectedly. In all these cases, central banks had to step in with extraordinary intervention. They did so well, because we do know how to do that, we as the central banking community. But of course, I think we should be more ambitious, and sort of our definition of the concept of resilience should be a definition net of public sector intervention.
Let's start with the banks, though, real quick. Looking not so far back, what lessons did you learn, or do you think we all need to learn from the Silicon Valley Bank and the Credit Suisse crisis?
Well, I mean, as I said, Silicon Valley Bank was part of a second-tier US banks that were kept outside of the international agreements. And for instance, the level of interest rate risk in the banking book that this bank was allowed to take would never have happened in a European bank. I mean, already in the annual report of 2021, you could have read that if the US Federal Reserve were to increase interest rates by 200 basis points, that basically they would lose some 35% of their capital. Well, that we would never have allowed, for instance, in European banks, where we do have a Pillar 2 approach with a hard limit that only 15% of your capital can be exposed to such risk. And by the way, the Fed did not end up raising rates by 200 basis points, it ended up raising rates by more than 500 basis points. So just to give you the kind of exposure. So interest rate risk in the banking book still matters, and it matters a lot. Liquidity risk also matters a lot. I think we've made great progress in managing liquidity risk with the LCR, the NSFR, again, two of these acronyms within the financial regulatory world. But what Silicon Valley has taught us is that actually if you have concentrated deposits, if deposit holders are concentrated in a sort of ecosystem of its own, which in Silicon Valley was the Silicon Valley producers, the highly innovative companies, etc., and all of these people are within the same WhatsApp groups, then all of a sudden the outflow of deposits can go much, much faster than we had anticipated, and also much faster than was actually assumed when we decided on the parameters for the liquidity coverage ratio in particular. So that's something that will need some revision, it will need some adjustment, not a dramatic one, but I think we have to show that we're agile there. And finally, this was also amplified by the role of social media, which I think plays a role in an amplification of a lot of factors, but unfortunately also here. So that is also something that we need to think about.
Thanks. Now let's switch from the banks to the non-bank financial sector. You already mentioned it. It is growing at a very, very high pace, and it used to be called the shadow banking sector. I never understood why, because first of all, they are not banks, and they're not also not operating in the shadow, so it's much better to call them, even if it's a new acronym, MBFIs. Now, they're growing so fast. Which stability issues do you see with them going forward? What are you looking at most?
Yeah, first of all, I think the term shadow banks, I also never didn't like it too much, because I think there was some pejorative element in there of banks doing shadowy things, etc. But I mean, what we really have to focus on is indeed non-banks perhaps taking on bank-like risks. No. The NBFI is a growing part of the financial system. I think it's even larger than the banking system now, if you look at it at the global level. It is good to have deep capital markets. Let there be no mistake about it. And probably we in Europe, we would like to see a little bit more NBFI rather than less NBFI. But nonetheless, NBFI also poses risks. And these risks are different from the banking side. If you the whole concept of resilience on the banking side, it focuses quite a bit on solvency. On the NBFI side, this is about liquidity mismatches. This is about having a lack of sufficient liquidity management tools to deal with these recurrent spikes in liquidity demand that happen every now and then. So what we have been doing is trying to create more resilience in the NBFI space. On the one hand, you can do so by trying to make sure that the main entities in the space, money market funds, open-ended funds, have better liquidity management tools at their disposals, that the supervisors also have the instruments to intervene if they feel uncomfortable about the degree of liquidity management tools. But then there are also a couple of what I would call cross-cutting issues in the NBFI space. I already mentioned the issue of hidden leverage. Now, it's difficult to think about a supervisory strategy because positions can change so quickly in this space that leverage can also move relatively quickly in this space. So the one thing that I believe that we can try to do here is make sure we get better data, we get better reporting, so that market discipline can actually help us to prevent in the future the buildup of these hidden leverage positions. And we will actually come forward with a a paper with policy recommendations from the FSB on this shortly. And then the second cross-cutting issue, it's a little bit of a technical issue, but that has to do with the lack of preparedness for margin calls. It's again a liquidity issue, but of course we've seen that in cases when market stress increases, there will be margin calls, there will be collateral calls, and we've seen inadequate preparedness in many, many parts of the NBFI space for such calls, which has amplified the stress, and which was also one of the reasons why central banks had no choice but to intervene to avoid a deeper fire sales and a sort of negative spiral of these panicky sales and further price declines, etc. So these are the issues that we are currently working on.
Okay, now we come to a topic you already mentioned in your opening statement, climate change. And the sustainability framework for banks is very much discussed. So how can you ensure, with the different views globally, that those sustainability frameworks are consistent globally? How can you ensure that also brown companies with adequate transition plans can actually be financed? What are your thoughts on those issues?
Very good question. On this question, I need a small qualifier beforehand. We are neither the climate policy regulator, nor are we the primary banking regulator. You know that the Basel Committee for Banking Supervision is the prime standard setter in the banking area. We coordinate the work of the bank standard, of the standard setting bodies, and we are also the political, the linchpin into the, let's say, the G20 being our political masters in this field. So we have a climate roadmap within the FSB that consists of disclosures, data, vulnerability analysis, and what we call regulatory and supervisory cooperation around the issue of managing and mitigating climate-related financial risks. Within the context of that latter strand, transition plans are very, very important. We believe that transition plans are actually a structured way to think about, for financial institutions, to think about their strategy and their risk management approach with respect to managing climate-related financial risks. If they are applied consistently, then these transition plans should also produce a wealth of information that should allow us, the FSB, to assess where we are on the spectrum of possible financial stability implications. And there can be financial stability implications from climate risk itself, but there can also be financial stability implication of a less than optimal transition toward net zero. It's a transition that would be much more abrupt and shock-wise, simply because we would start too late and then have to do too much at too late a moment of time. So these transition plans, I think, are a crucial information element in there, but the prime responsibility lies with the banks and with the financial institutions. So far, there is progress, but the consistency and the comparability is not at a point, unfortunately, in which it would allow us to also use that information for our vulnerabilities assessment at a more macro level. So I think there is still a lot of work ahead of us. We try to have as close coordination and communication with the banking industry, the financial industry. Think about the GFANS initiative that we sort of regularly talk to and have roundtables. Last week, I co-chaired the roundtable jointly with the GFANS on these transition plans. But for the moment, it seems to me that the ball is now in the park of the banks and the financial institutions to make sure that there is more progress in this area of consistency and comparability of transition plan information.
And stress tests play their role in all of that.
Absolutely.
As we have seen, not only
Think the unthinkable, yeah.
Thinking the unthinkable. Now, there cannot be a panel without touching the topic of digitalization, whether it's, CBDCs, AI, DLT. How does the FSB and how do you think about the new technologies which have a financial stability aspect, as discussed in previous panels before, in themselves?
Yeah, as the Financial Stability Board, of course, we are primarily interested in digital innovation within the financial industry. CBDC is a digital innovation within the central banking community. So that I would put that a little bit aside.
Which will come into the financial sector then?
Well, there is always the issue of the balance between public money and private money, and whether also, for instance, and it was already rightfully identified earlier that wholesale CBDC can, of course, also provide the rails for a lot of payment system innovations also on the private side, and definitely from our side. Digitalization is there, the whole world goes digital, so central banks should also go digital, I think, in the provision of public money, and we should not stick to banknotes, which is essentially a technique of the 18th century, right? I mean, there are more modern forms of providing public money. But this is not the prime area of attention for the FSB. For the FSB, we are focusing very much on AI and tokenization. Tokenization so far has not really taken off the ground yet. I think it has a huge potential, but we're not seeing that being applied at a scale in which it would become sufficiently material for us to think about financial stability risks and financial stability implications. But if it were to scale up significantly, then of course we would have to think about what kind of new forms of interconnectedness could it bring to the financial, what kind of new forms of financial stability risk. Choice of the settlement asset is quite crucial, and tokenization might therefore also have an impact on liquidity conditions in the market for this settlement asset. Tokenization might bring in new players that are not so well versed into the traditional financial regulatory perimeter, that don't have a lot of dealings with supervision and regulation in the past, that may have difficulties with issues like compliance and having to fulfill your legal and regulatory requirements. And then finally, DLT is there. It has been around for a while, but it has not yet been tested at a massive scale. So there are also, I think, a couple of unknowns there in terms of how DLT will behave if it were to scale up quite significantly. Now, that is tokenization. On AI, I do think that we are seeing a lot of applications nowadays. The FSB already in 2017 put out a first paper on the financial stability implications of AI and machine learning. We are in the process of updating that paper, and we will actually in a few weeks' time send it to the G20 summit, because even the leaders were interested in the financial stability implications of AI, not just the finance ministers, which is sort of the normal audience that a person like me talks to, but this is really the leaders for the Rio summit wanted to have the FSB produce a paper on the financial stability implications of AI. Now there, again, the question is what different or additional forms of interconnectedness would AI create? There are, of course, issues surrounding outsourcing and third-party dependence. There are significant issues about concentration risk. Let's take a very concrete example, large language models. Normally we think about innovation as letting the 1,000 flowers flourish. Well, in large language models, there are only 3 flowers. That essentially, all the models in use are a variant of, in essence, 3 models. So you understand that there is a certain concentration risk there if the entire industry uses application of what is essentially the same model or very close to a model. It creates, of course, a model risk by definition if you use models. And so these kinds of new risks is what we identify in the report. Let me also say, we always take the umbrella principle here within the FSB, harnessing the benefits while mitigating the risk. If you put a person like me on a podium, of course, I very quickly talk about risks, because that is what the FSB is for. But also here, we think that AI, we nonetheless think that AI has also huge opportunities in creating more operational efficiency within financial institutions, making better tailored products for many clients and what have you. So we're not blind to the opportunities, it's just our task to also think about what new risks it can bring.
Normally, I would have asked you another question about the global payment system, and if you can be very quick in your answer, how do we get to a, and can we get, should we get, and how can we get to a global payment system?
Well, that's a very difficult question in 10 seconds. We have a payments agenda on making global payments cheaper, faster, more inclusive, more transparent, and that is really of the essence. That's not just a technocratic problem. For those parts of the world where payments are not fast, where payments are outrageously expensive, where they are exclusive, I think the success of our project here will be nothing less than food on the table. So I think it is crucial that we have success on our payments agenda. What the end product of that agenda will be, I don't know in its precise shape, but it is important that we meet the goals that we've set ourselves here in terms of cheaper, faster, more inclusive and more transparent payments for all the citizens of the world, not just the privileged ones.
Klaas, thank you very much. You are a very experienced regulator. I have a huge respect for you, and it's very, very good that we have a guru like you, as Augustin Carsten said, looking after our regulation. So thank you very much. A big applause for...
Pleasure.